Scalping is hard. Scalping this, scalping that. So many traders talking about scalping, yet very few know how to actually be profitable with it. Take a seat and watch this video. We will talk about how to get winning setups by scalping the right way. So the first step is just simple understanding of how we will view the directional bias each time we enter into the charts to start our trading session. Now this example is just a simple presentation of the price action, but in step 2 I'm going to explain it slightly more complex and in detail. Now, the first thing we should do before taking any other decision is to understand what direction the market is trending in. We should understand that very well in order to make sure that we are trading in alignment with the higher time frame. So clearly at any given time, the market is creating a series of highs, lows, lower highs, and lower lows. So this price action shows a break of structure down here, meaning that we're bearish right now. So if we would meet this price action on an actual chart, looking to trade this price action that forms a high, a low, another high, but it's lower than the last high, and another low, but it's lower than the last low. So just by seeing this pattern that is repeated, I would be expecting price to continue trading lower. Then you would likely be expecting some kind of pullback to the upside before a continuation. So this would again be another break of structure. Basically just a continuation of the trend. So far it's pretty simple, but what oftentimes happens is that eventually a trend loses strength, and we have a trend reversal, a market shift in the other direction. So when price has been forming lower highs, lower lows, lower highs, lower lows, basically this decreasing market structure, at some point it will probably come back up and form a higher high. This is the first major sign that the trend can very soon reverse to the other direction. And this is what we call a change of character, or a market structure shift. They're essentially the same thing, however you want to name them. This change of character, it's essentially the trend reversal from a bullish market to bearish market, or trend reversal from bearish market to a bullish market, which is the scenario that we see on the screen right now. So in case that we get this change of character, we would be expecting that the price will probably have a pullback to the downside, followed by a continuation of the upwards movement, and again a pullback, and again continuation. So what we need to understand is where the price stands right now, right at this moment, to understand where market is likely to move towards. For example, if we know that we're taking out previous highs, and we're protecting old lows, then we're bullish, so we know that we want to look for buy-long setups on that specific day. Now moving into a more realistic view of the price action, where we have internal price structure as well. And the next advancement we are going to have is moving into the charts. But before that, we need to clearly understand what we are going to look for on a more simplistic presentation. So the first thing we do in here on a market that looks like this, we need to understand the market structure. So what we should do first is to analyze the swing levels. So we mark the highs, we mark the lows. Then we see the market pulling back up and forming a new swing high. The new high being situated lower than the last high, meaning we got a lower high. Then after the pullback, we got a continuation of the downtrend by a large downside movement. Move that forms new lower lows, and also signals the break of structure. So on downtrends, the lows are also called weak lows. Weak because in theory the lows get broken. And also in downtrends, the swing highs are also called strong highs, because the market is not supposed to break them, but to hold them instead. Now pay attention to this move because this is where a lot of traders get confused. So we confirmed that we are in a downtrend. But when traders see a break of the highs, they instinctively believe this must be a trend reversal, and they would look for buying setups. But the problem in here is that this is a break of internal highs, and not a break of external highs. This is crucial to understand, and a mistake to avoid. What we should be looking is to the external market structure, and a great solution for this is to mark out the external highs and external lows, and make sure to drag a line. Now as I said earlier, the lows should be weak and broken, and the highs should be strong and defended. Anything inside is not relevant for the external or high time frame trend. The inside price action is the internal price action. We are also going to see this internal price action, but later on you're going to see on the charts. These internal levels often get broken because they have pools of liquidity above or below. So this upside break of the internal high is more of a liquidity sweep rather than a change of character. So the actual change of character would form if the market would break out a previous external or swing high. It's only at that point where we would think about a trend reversal. So make sure to not get trapped by internal levels when we're doing external market analysis. So unless the market breaks a previous swing high, we will be looking for selling positions. If the market breaks above a previous high, then we would consider looking for buying setups. The reason is because the market finally forms the change of character, which is later followed by a downside pullback that ends up higher than the last one. And then finally the market breaks above the last highs, forming swing higher highs. So if we only see this price action, we would expect the market to now form an uptrend bullish price action. So basically another pullback, area where we would look for buy-long setups. Later followed by a continuation towards the highs, breaking the highs and forming higher highs. And of course, for the opposite market structure, the theory is similar, just the opposite way. So instead of initially having lower highs and lower lows, we have higher lows and higher highs. The weak levels are the highs in this case, because the market is in an uptrend at this point, and highs and uptrends should break into new highs, and the strong levels are the lows, since they should be able to hold the market basically to not break the down. Make sure to mark the swing external levels and watch the breaks of structure, and the change of character as well, because we need to avoid getting trapped by internal structure. So right here, this is not a change of character. It might be internally if we switch on a lower time frame, but what we care the most is the external change of character. So this is just a liquidity sweep on the internal structure. The actual change of character happens here, where the market finally breaks down the strong lows, essentially turning them into weak lows, and also into strong highs. Basically a change of character that has flipped the market from an uptrend into a downtrend. What we would expect now is a pullback to the upside, level where we would look for selling opportunities to take the market into new lows, since we now have weak lows. Now into the second step, how to identify liquidity manipulations. So as I said the last video, liquidity is what drives the market, and we need to know that trading itself is a battle of the big players, the big institutions. They hunt each other, and us as retail traders just look to join the winners. These institutions usually target levels of liquidity in the market, because liquidity allows them to either exit their positions or open new positions, making them levels where a lot of orders are being opened, so money being thrown in both ways. Because remember, for a buyer to close his position, there must be someone willing to sell at that price, and for a seller to close his position, there must be a willing buyer at that price. And when there are way too many of one side, so way too many buyers, or way too many sellers, that gathers a pool of liquidity near some levels. Those levels are usually seen on the charts as right above equal highs, right below equal lows, even above or below trend lines, support, resistance, and even previous day highs and lows. All of these levels are loaded with a lot of orders, especially stop losses from one type of trader, and entries from the other type of traders. So what often happens because liquidity gathers into a small price area, you might often see, or you probably already experienced it before. As example, the market breaks the equal highs, giving hope for buyers, but then the market just reverses back down. And essentially the buyers got stopped out losing their trade. Well, the buyers in this case got caught in a liquidity sweep. Now on the case where the market initially follows an uptrend, with swing higher highs and swing higher lows, and eventually the market forms equal highs or equal lows, or any kind of liquidity structure that respects the continuation of the main trend. We wait for the market to take out that liquidity, levels where we would look to plan our setup. So how can we capitalize on this plan? This is what we're going to talk about right now, how to actually trade this strategy. So the first thing, as I said earlier, we mark the swing levels, the strong and weak levels. The next step, we identify liquidity. In this case, we got liquidity in form of these equal highs and equal lows. Now, because the trend was bearish, we would expect that the market would rather break the equal highs first to later take the liquidity from the equal lows. And that is because the first move is a manipulative move. The second move is the actual intention of market direction. And when the market breaks the equal highs taking that liquidity, we have two options for the setup. We can look for a previous swing supply zone, or swing fair value gap. And we will take a sell short in this case, with the stop loss above the swing high, and take profit below the swing low. Now keep in mind that if the risk-reward ratio gets too large, I will look to close the position earlier so we don't risk too much. And the second option, when the price breaks the equal highs and approaches a swing supply or fair value gap, instead of trading that zone, We zoom into a lower time frame. We then look for a change of character on the internal structure, and we identify if there is a supply or an imbalance in the low time frame. And we trade this setup instead, so a sell position. Stop loss above the low time frame imbalance or supply. For the take profit, this setup allows very high risk to reward ratios. This is a plan for sniper entries. The best case scenario would be to have the take profit near the swing lows. This makes a swing trade with very high risk reward. There is also option for target placements, basically just scalping the internal market structure. And this can be done multiple times in a trading session. Now in the scenario where the market is initially bullish, starting with the market structure analysis, we got protected strong lows and weak highs. Now when the market forms equal lows and equal highs internally, and the market was following an uptrend before, the more likely scenario is that price will first break down the equal lows to first take out that liquidity. Now we have two options. We can look for swing demand zones or swing fair value gaps to take the market into new swing higher highs, this being a more swing type of trade, or we can scalp a setup. And how we do that is by zooming into a lower time frame when the market approaches a swing demand or swing fair value gap. Then we look for an internal change of character on the low time frame, waiting for the pullback where we can identify if there is a low time frame demand or low time frame fair value gap to take the market into either new swing higher highs. So basically a swing trade with a higher risk reward ratio, or we can scalp the setup by taking a 1-3 or 1-4 around there. And this type of scalp can be done multiple times in a trading session. So let's go into the charts and apply the strategy. This is the gold market on the 15-minute time frame. We start with the first step, basically analyzing the market structure, but more importantly, the external market structure right now. So we got a higher high with a downside pullback, a break of the highs, a pullback again, another higher high, pullback again, higher high, pullback, higher high, pullback, and finally a last higher high, which is followed by another pullback. Now we need to closely pay attention to the recent price action, which is this final pullback. If we look at it, it is actually broken down below the swing lows with a wick. A break of swing lows in an uptrend is the first major sign of a trend reversal, and therefore is a change of character. The only things that we are doing is applying what we have talked earlier in the video on those simple price action presentations. So usually if we look for a trend reversal, we would expect a pullback to the upside towards the highs, but the market to form lower highs on the swing levels where we can look for an entry structure that favors selling positions. We look for that entry structure on all of these last candles that caused the last directional move. And if you are a long viewer of my channel, you probably are skilled enough to identify this certain bearish fair value gap. Now we have two options. We can simply just sell short right here with the stop loss above the gap, take profit below the lows, and basically trading a swing position, or we can do something else. A second option would be zooming into a lower time frame when the price is near or at the imbalance. So from the 15-minute, let's zoom into the 5 minutes chart. Now we can look for an entry structure inside this lower time frame. This process of lowering down into time frames is done to increase the quality of the setup, but also to get higher risk to reward ratio setups. And if we pay attention in this time frame, there is also a fair value gap right here, which is the most recent one from where the price is approaching. Now keep in mind this is an internal fair value gap. It basically means that it's simply just a low time frame gap inside a high time frame gap. And now we could look to sell short on this setup, with an entry on the internal gap, stop loss above the gap, and the take profit usually goes below the structural swing lows. Now we've entered the position right here. What we can do even further is to zoom into a lower time frame once again to see a more clear view of the price action and market structure. So from the 5-minute time frame, let's jump into the 1-minute time frame. Doing a quick analysis in here, lately on the recent market structure, the price broke above the last highs, forming a break of structure. There is also liquidity here in form of equal lows, so we need to know below these lows there sit a large pool of stop losses, which also coincides with being exactly on the last internal low level. And of course, there is also liquidity resting below the swing lows on the external structure. Breaking the external lows will hold the continuation of the downtrend. And that's why I have the take profit there, because I trade with the trend and the expectations of a downtrend is to form lower lows until a reversal forms. But we don't know when the reversal will come. Look at the formation of the price action. It's moving in the favor of the position. It has basically formed lower highs. And lower lows, it just needs to hold this price action, and it's slowly moving downwards. Here, once again, lower highs and lower lows. And finally, it moves into take profit, with the last candles having increased volume. That just shows that many orders have been triggered, both stop losses, entries, but also take profits. So to simplify this entire planning of the setup, on the external structure, we just had a downtrend with lower lows and lower highs. And all we did is to sell short the pullbacks into trend continuation. You can also use the external structure to trade the pullbacks on the internal structure. I'm going to show you in the next trade how this is done. But first, we need to understand what we're talking about. And the simplest way to do it is to first see how it works on a price action presentation. So on the last trade, we had a market following a downtrend. And all we did is to sell short the pullback into continuation. Now there is the other option, where if we see the market forming a new swing low recently, and it forms an internal higher high, basically a change of character towards the bullish side, but on the internal structure, we can look for buy-long setups to take the market into a swing lower high. Now why a swing lower high? Because we only use this short-term pullback as a quick scalp opportunity. We are still bearish on this market on the swing structure, and the take profit should be placed at a bearish entry structure externally, because this structure has a high probability of taking the market into new lows. And this also allows us to enter another position, just to sell this time. Now let's check how that would look like into the charts. So here on the Nasdaq, initially we had a slow downtrend, kind of a consolidation or slow movement, basically a lack of liquidity and decrease of momentum. But that did not last long because a couple minutes later, we've this massive downturn with way larger candle sizes than we've had before. These type of massive candles very often leave an imbalance on the chart. And there is a bearish fair value gap present right at this point. Remember, the bearish fair value gap is taken from the previous candle to the large one. So this is the first candle, and the gap is taken from the lower wick of the first candle to the higher wick of the third candle. The third candle being the one next to the larger candle. And this entire zone is the bearish fair value gap. Now pay close attention to the market structure that formed right after we've got the downside push itself, then a small pullback and continuation towards new swing lows, then again an upside pullback, but this time, buyers had more strength to push the market slightly more. And again, downside movement. But finally it started gaining bullish momentum and it formed a higher high on the internal structure. So let's make sure everyone sees the swing and internal structures well. Here at the top, we got the clear lower high. Lower at the bottom, we've got the lower low. Then we got a higher high from the upside break. Now also pay attention to this lower low. It is broken down below, but has quickly reversed back up. I would consider this more of a liquidity sweep. For an obvious swing new structure, we would have wanted to see a candle closure below. But it's fine, let's keep it as a lower low because it's not that relevant currently. So getting into the most recent movements, remember the higher high that we've talked about a minute ago? An internal higher high in an internal downtrend forms an internal change of character towards the bullish side. Now what follows next is a short pullback followed again by an upside push that breaks into new internal highs. So basically we've got the first validated bullish break of structure inside this internal trend. And because of the last liquidity sweep to the downside, we would expect another one yet again to the downside, because the smart money or however moves the market has shown their intention to liquidity lows and using their liquidity to push the market into the external fair value gap. Level where they would probably trigger their large selling positions to take the market into new swing external lows. We look if there is a near entry structure, and there is a small fair value gap in here. A bullish fair value gap is taken from the wick high of the candle previous to the large one, to the lower wick of the third candle being the one next to the larger one. And we can look for buying setups on the fair value gap, with of course multiple options. One option would be to have the stop loss below the gap, and take profit above the recent internal highs. Another option would be to target the fair value gap since we know there are many orders in form of liquidity there. But this makes the setup kind of riskier because of potentially too high risk-reward ratio. So we keep it like this, And let's check the price action. So in the next couple candles, the price takes the liquidity from the internal lows, which fills the fair value gap and triggers the entry on the position, and instantly prints a very bullish candle. This shows that many traders have saw this opportunity, with many buying orders being placed on that gap. And the next candle closes the position in take profit, and also it fills out the external fair value gap. So let's see the upcoming action in the market. And just like expected, after filling the bearish fair value gap, it has moved into new swing lower lows on the external structure, and respecting the rules of the setup, so entry on the gap, stop loss above the gap, and take profit below the swing lows. So it has also respected the rules. So just so you know, you can trade both the internal structure and as well as the external. Now you need to be careful of invalidations. One of the most common ways the market will invalidate this strategy happens when there are high-impact news incoming near a textbook perfect price action that has first respected the plan. So let's look in here to understand how that would look. This market is obviously bullish, having their higher lows being formed, with their higher highs as well, that on the internal structure, and if we only look at the external one, we see an upside push, a pullback that ends up higher than the last one. So let's quickly mark the swing zones. Here at the beginning, we've got the higher low, then we got a higher high. The pullback ends with another higher low, then another upwards push that marks a higher high, and again a pullback with a higher low. Now the upcoming price action has formed a sort of sideways movement, showing a loss of momentum and volume. But closely pay attention to this swing low, because it has broken down below, but instantly recovered back up, and it formed a higher high on the swing structure. Then we would have look at an internal uptrend with a potential demand or fair value gap in order to take the market into new swing highs. But what happened instead is that the market pushed down aggressively with a massive bearish candle. Now this candle was caused by high impact news. On these type of news, the market is pretty random, especially on the low time frames. So the simplest way to avoid making this mistake and getting trapped is to just watch the economic calendar each time you enter a trading session, and try to avoid having positions or setup plans near high-impact news. You can as well get the skills to get setups like we've got in this video. I have the resources on the link on the description, but also if you liked the video, make sure to subscribe. Thank you for watching and have a great trading session.